Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fine. Good morning, everybody. Oh, wait, why is the camera not working? I gotta fix that. Well, you know, I don't really have to fix that because you don't really need to see me all that badly. There we go. How you guys doing? Now, I hope that y'all had a good morning since we stopped trading here. Come over here and just take a quick look at the markets here. S&P 500 did take a little bit of a dip down, but has since recovered and is at the moment on the uptrend, as are the bonds. Market seems to be thinking that something is dovish is about to happen. I do see Jim Uriel saying something about Nick tweeting something, but I don't see the tweet that they're talking about. So I don't know what that's all about. But another thing that I am seeing is for the past 30 minutes or so, the dollar, you can see, has been dropping down pretty hard. You can see it down on the bottom here on my screen, dollar dropping pretty hard in the last 30 minutes. So that is kind of interesting to me. It does seem like some portions of the market seem to think they know where this is going to go. Well, I feel like I do feel like I'm missing something. I was crafting my own white noise a little bit earlier, and now I just have the sound of white noise stuck in my head. Shall we put in some drum and bass here for dramatic effect? There we go. There could be, I don't know. I still think that Federal Reserve doesn't want to rock the boat ahead of midterms and everything. But there sure is a lot of risk on this one event, right? I'm no way that I would be holding a position on a live account through this event we're about to get here. Although I doubt the actual release is going to be all that crazy. Dollar reversing a little bit here now. Definitely hearing plenty of like headlines and stuff. One minute to go. Take my hand off the trigger. I gotta look. See, somebody's selling it. Selling the micros. Like somebody's eating up contracts ahead of this. I don't know, man. This is a little scary. I don't know, but we're gonna know here in like 10 seconds, 20 seconds. Here we go. That's a pull. Yeah, that's a pull. Not even. Okay, so it is a 75 basis point hike. Okay. In order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time in determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. That is the change. That is the change that they made. Is that bullish or bearish? I don't know. What? I think that suggests... I think what that means is that the Federal Reserve... let me read it again first before I say what I think it means. I think it is dovish, though. Fact. Shit, I already missed it. Okay. In order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time in determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. So I think what this means is that the Federal Reserve is saying we can back off before we actually see the change in some of the data because we know that there's such a significant lag in policy, is what I think they're saying. I wish I had something I could just copy and paste. Here we go. This is huge. This is huge. I said I didn't think that it was going to be anything too significant. This is huge, I think. This is like This is something that could decrease rates like 20 basis points. I'm not even joking. Let's just watch it. I have some food here to eat. Let's just keep an eye on what they do here. Man, it really makes me nervous to say something like this. So I want to be very clear that what I'm about to say is not financial advice or trying to induce anybody to change, trade, or anything of that nature. But I feel that that change in the Federal Reserve statement is one of those close your eyes and click buy kind of moments. This market, I mean, they already moved up a ton in the S&P 500, but this is the sort of thing that could lead the S&P 500 and the NASDAQ in particular to be up like 2 to 4% today. So like there is like plenty of upside left in this probably. You might have to sit through like really crazy pullbacks, but this is going to move. This is going to move big. That can't be right. I'm just hearing over the news squawk that they're saying that the expectations for rates to hike 75 basis points in December are rising, or it's like almost a lock for 75 basis points now in December. Huh? Yeah. Mohammed A. L. Arian, as to what's next, I suspect the entire focus will be on interpreting the additional language in the statement. Markets are not waiting for the press conference to interpret this as dovish. It will be fascinating. Yeah, fascinating is probably understatement, right? The rates that I'm seeing here from the micro treasury markets don't seem to be right, but I think that we are seeing a really crazy amount of steepening, so the 30-year is lagging mundo big time. Let's see if I think that the rebalancing that I'm seeing here in the 10 years so far is pretty encouraging. I was concerned that they would come all the way back, as often sometimes happens. I do think it does kind of feel like that there might be some contrarian trading off of this too. I mean, I could totally understand why somebody might want to come in and be contrarian about it, but I would say that the statement itself is just about the most dovish thing that I think they could reasonably put in the statement. Like, and I think it's really not meant to be like, oh, we're not going to raise interest rates as far or anything like that. But I feel like that the statement is much more like a pushback against some of the criticisms in the market of the Federal Reserve, basically saying, well, by the time you guys realize that you need to back off, it's already going to be too late. And that statement in there basically says, we know what's going on. We know what's going on. What are you scranning on? What do you mean by that? Is that even a word? Scranning? Is that kind of like canning? Like when you don't? Or are you asking me what I'm eating? Because I am eating hamburger helper. I know. So healthy, right? I'm eating hamburger helper. You were probably expecting me to say something super appetizing and stuff, right? But no, you know what? I'm a little ADHD, and one of the things when you're ADHD is eating is boring. You just want to get it. You just want to get the nutrients in the body and move on to the next thing. That's me. huge pop in the euro. I hope Powell doesn't ruin that. Well, this puts us in an interesting situation because it's always difficult to hold a position through the press conference, and there can be a lot of really annoying volatility during the press conference. But that statement really makes this whole thing a really good setup, like, I think. Right? Which direction it actually goes in the press conference remains to be seen. I would be really shocked to see him come in and say something that like completely erases that pop in the S&P 500 though. Right? I mean, that would be a really shocking turnabout. I'm sure that he will put some like addendums onto that. Like he's gonna say, well, yeah, we're still gonna raise interest rates, right? And we're probably still gonna keep interest rates higher for longer. It's still, I think it's a really big change, and I think that it's a real play to try and what is the word, assuage the concerns that people have about the Federal Reserve almost certainly sending us into a recession and stuff. Kevin, not even gonna read that. Not even gonna read that for fear of spreading misinformation. Forex Live tweets, US dollar falls broadly after the Fed hints at a slower pace of rate hikes. I selected drum and bass. Why is it giving me hype? Okay, sounds like the SOFR futures are moving around quite a bit, but my news squawk is now saying that the 50 basis point hike has overtaken as the most likely move. There may be some people here kind of a little bit hesitant to like fully jump on board this. I think I do see a little bit of skepticism out there as I'm reading what everybody's saying and the tweets and stuff like that. Looking at bond action, they do not see the statement as dovish as there is little steepening. Things are key to listen to are Fed data dependent on for December hike. 2, what do they mean by sufficiently restrictive? This is $1 million question. Well, so you see, like, people are waiting for the press conference, right? That's what it looks like is happening to me. But when I look at the volume and where we are compared to yesterday, you know, like just the overall volatility and everything, like there could be so much more potential out of this move. If Powell comes in and says, "Oh yeah, it means exactly what it says," and the market interprets it as dovish, I think there could be a lot more upside. I do not like the prices they're giving me in the 30-year though. Would have preferred to be short 4%, but that's okay. I'm going to take the risk in this case. Did something happen? Yes. I'm sorry, NJ. So YouTube changed the channel page so that when you go to my main YouTube page, there's different tabs for videos, shorts, and live streaming. So before, I was unlisting my live streams after they finished so that they wouldn't clutter up the home feed. Now that that's not there anymore, I made them listed all public. And apparently when I marked them back as public, YouTube sent like alerts and stuff out. So I apologize. I didn't know that it was going to do that when I did that. I just said, "Oh, okay, I've been waiting for this," and I marked them all public. And you're not the first person to complain today. Let's just put it that way. It will get further down with some time. Yeah. So like one of the things that's really annoying is that if you go to the live stream page, they're not in chronological order because it sees them as all being posted yesterday. So it'll take a few weeks for that page to clean itself up and stuff. Fortunately. Although I think that the playlist should still be fine. So yeah, you see they're not quite getting outside of this range. It's just kind of chilling here in the liquidity hole around, let's say, 03. First move is usually the wrong move when it comes to the FOMC, says the street. That's true, but I would note that the first move in the treasury market was actually down. So there was that little spike down. It was probably just like a one contract or something that decided to sell. But somebody got filled down there at the bottom and is a lucky bastard. Ray Sizzle, welcome back. How are you doing? It really feels to me like there is a unusually high amount of skepticism over a change that was so significant. I think that was a really major, like, so just think about how the Federal Reserve meeting works, and that they're looking at that statement and they're saying, okay, how are we going to change this statement? What are we going to put in? What words are we going to put in here? And how they're selecting their words and everything to convey the change in their thinking and so forth, right? Like, that's a very meticulous process that they go through. So they didn't just put that in there for shits and giggles, right? So I feel that the market kind of being like so weary about it, I think is a little unjustified. Granted, I think that people are right that, yeah, it's still a 75 basis point hike. Probably they do 50 basis points in December, like we thought from the Wall Street Journal story from a week ago or so. Yeah. Okay, so here's Steve Leishman. I have to wonder if the Fed's statement that it will take into account lags of policy is a compromise necessary for Fed Chair Powell to keep the committee unified. So still hawkish in terms of policy direction going up, but Powell corralling the doves with a nod to lags. Yeah, that is exactly what it is. I mean, I don't even know if it's on the committee, but people have been criticizing the Fed. They're saying what you're looking at is lagged. By the time you see it in the data, it's going to be too late. It's a good point. And I've always said, well, the Fed's not stupid. They can use whatever data they want, and they look at it's discretionary. But now they're straight up saying it in the statement. I think that's a really big shift. And with the way that the market's been going, I think it's an important shift. Oh yeah, we need to pull them up. Right? So the conference is starting now. YouTube.com/Federal Reserve. So I'm going to go over to here.
Seeing
back down
NYMEX
to our
diesel
2%
December
goal.
futures settle at
We
$3.67
have
a
both
gallon.
the tools that we need and the resolve that
Fed's
will
Powell
take
says
to
without
restore
price stability, we will
on
not
behalf of
achieve
American
sustained
families
labour
and
growth.
businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all.
Powell says we are moving
Today, the
purposefully.
FOMC
Also,
raised our
NYMEX
policy
gasoline
interest
December
rate by
futures settle
75
at
basis points, and we
$2.69 a
continue
gallon.
to anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we're continuing the
Fed's Powell
process
says
of
we will
significantly
likely need
reducing the size
restrictive
of our balance
stance
sheet.
of policy for some time.
I turned
Restoring
him
price
off.
stability will likely
There we go.
require maintaining a restrictive stance of policy for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Real GDP rose at a pace of 2.6% last quarter, but is unchanged so far this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 289,000 jobs per month over August and September. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in September, total PCE prices rose 6.2%, excluding the volatile food and energy categories. Core PCE prices rose 5.1%. And the recent inflation data again have come in higher than expected. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has created additional upward pressure on inflation. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 75 basis points. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. With today's action, we've raised interest rates by 3.75 percentage points this year.
Okay,
We anticipate
moving here.
ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Financial conditions have tightened significantly in response to our policy actions, and we are seeing the effects on demand in the most interest rate sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. That's why we say in our statement that in determining the pace of future increases in the target range, We will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation. At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest
So there
rates
he's mentioning the jobs numbers. That's definitely
our decisions will
moving them.
depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal.
Like what it is.
Longer-term
Pretty
inflation
bad.
expectations are well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you, Colby. Thank you. Colby Smith with the Financial Times. On the need to slow the pace of rate increases at some point, is a contingent on a string of better inflation data specifically between now and, let's say, the December meeting? Or is that something that the Fed could potentially proceed with independent of that data, given the lagged effects that you mentioned?
So a couple of things on that.
Maybe I need
see
to.
inflation coming down decisively, and good
that off.
evidence of that would be a series of down monthly.
Gonna hear that sound a
Of
lot
course,
here.
that's what we'd all love to see, but I've never thought of that as the appropriate test for slowing the pace of increases or for identifying the appropriately restrictive level that we're aiming for. We need to bring our policy stance down to a level that's sufficiently restrictive to bring inflation down to our 2% objective over the medium term. How will we know that we've reached that level? Well, we'll take into account the full range of analysis and data that bear on that question, guided by our assessment of how much financial conditions have tightened, the effects that tightening is actually having on the real economy and on inflation, taking into consideration lags, as I mentioned. We will be looking at real rates, for example, all across the yield curve and all other financial conditions, and as we make that assessment.
I really would have preferred the first question to have been about the key statement change.
Howard Schneider with Reuters. Look, I'm sure there's going to be tons of confusion out there about whether this means you're going to slow in December or not. Would you say that the bias right now is not for another 75 basis points?
So, what I want to do is put the question of pace in the context of our broader tightening program, if I may, and talk about the statement language along the way. So I think you can think about our tightening program as really addressing three questions. The first of which was and has been how fast to go. The second is how high to raise our policy rate. And the third will be eventually how long to remain at a restrictive level. So
Yeah.
on the first question, how fast to tighten policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3.75% since March, admittedly from a base of 0. It's a historically fast pace, and that's certainly appropriate, given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy rate, and we're saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time, and we put that into our post-meeting statement. Because that really does become the important question, is how far to go, and I'll talk more about that. We think there's some ground to cover but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say, we're going to find it over time. Of course, with the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy as well as the lags with which monetary policy affects economic activity and inflation. So I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases.
There you go.
So that time is coming.
So that's why they moved.
As soon as the next meeting or the one after that.
Ah.
The decision has been made.
So he's saying there is no decision, but it does kind of sound like he's saying we might only do 50 basis points in December.
To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restricted, which really will be our principal focus.
If I could follow up on that, to what degree was there an importance or weight given to a need to signal this possibility now, given all the concerns really around the globe about Fed policy sort of driving ahead and everybody else, dealing with their own stress as a result?
Well, I think I'm pleased that we have moved as fast as we have. I don't think we've over-tightened. I think there's very difficult to make a case that our current level is.
Okay, so one thing Steve Leishman is pointing out here, Powell is clearly opening the door to a 5% or higher funds rate by saying that the outlook for rates is higher than it was in September. The average Fed official forecast was 4.6 cents, so higher than that. And the consensus forecast right now is 5%. So it's that statement in and of itself is not necessarily a huge change to them or change in expectations for the market.
I don't have any sense that we've over-tightened or moved too fast. I think it's been good and a successful program. We've gotten this far this fast. Remember, though, that we still think there's a need for.
Really, not everybody in the market agrees with Powell that it's been a fair and successful program
here.
There's so much volume going through here in the S&P.
Core PCE inflation on a 3 or 6 month annualized basis and on a 12-month basis has been running in the high 4s, close to 5%. Is there any reason to think you won't have to raise rates at least above that level to be confident that you are imparting enough restraint to bring inflation down?
So this is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. But I would think you'd look more at a forward, a forward-looking measure of inflation to look at that. But
in other words, it doesn't have to get above 5%.
The answer is we'll want to get the policy rate to a level where it is where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end of at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher, and I think financial conditions have tightened quite a bit. So I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
If I could follow up, what is your best assessment or the staff's best assessment right now of the current rate of underlying inflation?
I don't have a specific number for you there. So there are many, many models that look at that. And I mean, one way to look at it is that it's a pretty stationary object, and that when inflation runs above that level, for sure, substantially above for some time, you'll see it move up, but the movement will be fairly gradual. So I think that's what the principal models would tend to say. But I wouldn't want to land on any one assessment. There are many different, as you know, people who publish an assessment of underlying inflation.
Hi, Chair Powell. Thank you for taking our questions. Gina Smilek, New York Times. I wonder, do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
Is inflation becoming entrenched? So I guess I would start by pointing to expectations. So if we saw longer-term expectations moving up, that would be very troubling. And they were moving up a little bit at the middle part of this year, and they've moved now back down. That's one piece of data. Shorter-term inflation expectations moved up between the last meeting and this meeting. And we don't think those are as indicative, but they may be important in the wage setting process. There's a school of thought that believes that. So that's very concerning. I guess the other thing I would say is that the longer we have, we're now 18 months into this episode of high inflation, and we don't have a clearly identified scientific way of understanding at what point inflation becomes entrenched. And so the thing we need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do and what we're strongly committed to doing.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. The statement points to lag times. I'm wondering if you can walk us through how you judge those lag effects, what that timeline looks like over the coming months or even a year, and where you would expect it to show up in different parts of the economy.
Yeah, so the way I would think about that is it's a commonly, for a long time, thought that monetary policy works with long and variable lags, and that it works first on financial conditions and then on economic activity and then perhaps later than that even on inflation. So that's been the thinking for a long time. There was an old literature that made those lags out to be fairly long. There's newer literature that says that they're short. The truth is we don't have a lot of data of inflation of this high in what is now the modern economy.
So 26.5 is VWAP.
Is that it used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before, in expectation of monetary policy. That's the way it has moved for a quarter of a century, is in the direction of financial conditions, then monetary policy, because the markets are thinking what is the central bank going to do. And there are plenty of economists that also think that once financial conditions change, that the effects on the economy are actually faster than they would have been before. We don't know that. I guess the thing I would say is it's highly uncertain. And so from a risk management standpoint, it would be irresponsible not to ignore them, but you want to consider them but not take them literally. So I think it's a very difficult place to be, but I would tend to want to be in the middle, looking carefully at what's actually happening with the economy. And trying to make good decisions from a risk management standpoint, remembering, of course, that if we were to over-tighten, we could then use our tools strongly to support the economy. Whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the costs, the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
And if I could follow up, should we interpret the addition to the statement to mean that more weight is put into those lag effects than they would have been after previous rate hikes?
So I think as we move now into restrictive territory, as we make these ongoing rate hikes and policy becomes more restrictive, it'll be appropriate now to be thinking more about lag. Of course, we think about the lags are just sort of a basic part of monetary policy, but we will be thinking about them. I think we'll be considering them, but because it's appropriate to do so. Let me say this: it is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go. Our policy. We need ongoing rate hikes to get to that level of sufficiently restrictive. And
Man, S&P doesn't like that at all.
We have a sense.
I think that this may be,
in the December
because you get people trapped in a trade. People like myself.
Which updates that. But
People like myself.
Continue to update it based on what we're seeing with the incoming data.
You just see somebody there in the micros puked hard.
As you look around the economy, the clearest impact of your tightening so far has been on housing, maybe.
I'm telling you, the first move was down, though.
It's been relatively narrow in terms of labor market, consumer demand, a lot of sectors you don't see it.
You go and look at that on a one-tick basis. The first move was down.
Policy works changing, is it narrower than it used to be? And on housing in particular, are you...
The first move was down in ES, too.
You're crimping housing supply in ways that might cause problems down the road.
I don't know that the channels through which policy works have changed that much. I would say a big channel is the labor market, and the labor market is just very, very strong, very strong. And
So now what you're seeing right there is stop runs?
Strong balance sheets. And so we go into this with a strong labor market and excess demand in the labor market, as you can see through many different things, and also with households who have strong spending power built up. So it may take time. It may take resolve. It may take patience. It's likely to get inflation down. I think you see from our forecasts and others that it will take some time for inflation to come down. It'll take time, we think. Sorry, was I getting to your question there? Housing, the housing part of it. Yeah.
Interesting volume there in the 5-year.
We look at housing. Of course, housing is significantly affected by these higher rates, which are really back where they were before the global financial crisis. They're not historically high, but they're much higher than they've been. And you're seeing housing activity decline. You're seeing housing prices growing at a faster rate, and in some parts of the country declining. I would say the housing market was very overheated for the couple of years after the pandemic as demand increased and rates were low. We all know the stories of how overheated the housing market was, prices going up, many, many bidders, no conditions, that kind of thing. So the housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there. From a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis.
Man, the 30-year just puked so hard there, too.
Much more carefully managed.
It came down from 24 to 08 in less than a minute? Wow.
Doesn't appear to present financial stability issues, but no, we do understand that's really where a very big effect of our policies is.
Hi, Victoria Guida with Politico. I wanted to ask about the labor market. You mentioned early on again that job openings are very high compared to available workers, and I'm just curious to what extent you do and don't draw signal from that. So, for example, if
this question could
and if maybe
shift
the unemployment rate
things.
starts to tick up, will that make you sort of decrease your focus on job openings? What do you see? Are wages what's really important? How are you thinking about the labor market as it relates to inflation?
So we talk a lot about vacancies and the vacancy to unemployed rate, but it's just one. It's just another data series. It's been unusually important in this cycle because it's been so out of line, but so has quits, so have wages. So we look at a very wide range of data on the labor market. So I'd start with unemployment, which is typically the single statistic you would look to, is at a 50-year low, 3.5%. We're getting really nothing in labor supply now. We had, I think, a very small increase this year, which we had really thought we would get that back. Most analysts thought we would get some labor supply coming in. You mentioned wages, so I guess I would characterize that as sort of a mixed picture. It's true with average hourly earnings you see. So I would call it a flattening out at a level that's well above the level that would be consistent over time with 2% inflation, assuming a reasonable productivity. There with the ECI reading this week, again, a mixed picture. The headline number was a disappointment. Let's just say it was high. It didn't show a decline. There's some rays of light inside that if you look at private sector workers, that did come down. The compensation did come down. But overall, though, the broader picture is of an overheated labor market where demand substantially exceeds supply. Job creation still exceeds, the sort of the level that would hold the market where it is. So that's the picture. Do we see? We keep looking for signs that sort of the beginning of a gradual softening is happening. And maybe that's there, but it's not. It's not obvious to me because wages aren't coming down. They're just moving sideways at an elevated level, both ECI and average hourly earnings. we want to see, we would love to see vacancies coming down, quits coming down. They are coming down. Vacancies are below their all-time high, but not by as much as we thought, because, and that, the data series is volatile. We never take any one reading. We always look at, 2 or 3. So it's a mixed picture. I don't see the case for real softening just yet, but we look at, I guess as I just showed you, we look at a very broad range of data on the labor market.
So do you see wages as being a significant driver of inflation?
I think wages have an effect on inflation, and inflation has an effect on wages. I think that's always been the case. There's always a going back and forth. The question is that really elevated right now? I don't think so. I don't think wages are the principal story of why prices are going up. I don't think that. So don't think that we see a wage price spiral. But again, it's not something you can, once you see it, you're in trouble. So we don't want to see it. We want wages to go up. We just want them to go up at a level that's sustainable and consistent with 2% inflation. And we do think that given the data that we have, that this labor market can soften without having to soften as much as history would indicate through the unemployment channel. It can soften through job openings declining. We think there's room for that, but we won't know that. That'll be discovered empirically.
Thank you so much. Kayla Tausche from CNBC. Earlier last month, the United Nations warned that there could be a global recession if central banks didn't change course. The new UK Prime Minister warned of a profound economic crisis there. And I'm wondering how the Fed is weighing international developments in light of a very strong economy here in the U.S. that would seem to be bucking those trends.
So, of course, we keep close tabs on economic developments and also geopolitical developments that are relevant to the economy abroad. We're in very frequent contact with our foreign counterparts, both through the IMF meetings and the.
You think 3750 is coming? Wow, that's quite a call.
With many central bankers. So
it's only just a little hop away now, though, isn't it?
I guess it's clearly a difficult time in the global economy. We're seeing very high inflation in Europe, significantly because of high energy prices related to the war in Ukraine, and we're seeing China's having issues with the zero COVID policy and much slower growth than we're used to seeing. So we see those difficulties. The strong dollar is a challenge for some countries, but we take all of that into account in our models. We think about the spillovers and that sort of thing. Here in the United States, we have a strong economy, and we have an economy where inflation is running at 5%. Core PCE inflation, which is a really good indicator of what's going on for us, is the way we see it, is running at 5.1% on a 12-month basis, and sort of similar to that on a 3, 6, and 9-month basis. So we know that we need to use our tools to get inflation under control. The world's not.
Look at that huge offer at 17.75. Oh, and they just traded through it like it was butter.
Stability in the United States is a good thing for the global economy over a long period of time. Price stability is the kind of thing that pays dividends for our economy for decades, hopefully. Even though it may be difficult to get it back, getting it back is something that provides value to the people we serve for the long run.
If I could just follow up on that. Thank you. The Fed has acknowledged in the past that the tools that you have don't affect things like energy and food prices that stem from some of those conflicts overseas, and they're some of the biggest pain points for consumers. So as you pursue the...
I'm going to try restarting NinjaTrader because I'm still...
Some of those prices...
Some of my charts are not cooperating.
So we don't directly affect, for the most part, food and energy prices, but the demand channel does affect them just at the margin. The thing about the United States is that we also have strong, in many other jurisdictions, the principal problem really is energy. In the United States, we also have a demand issue. We've got an imbalance between demand and supply, which you see in many parts of the economy. So Our tools are well suited to work on that problem, and that's what we're doing. You're right, though. We don't, the price of oil is set globally, and it's not something we can affect. I think by the actions that we take, though, we help keep longer-term inflation expectations anchored, and keep the public believing in 2% inflation by the things that we do, even in times when energy is part of the story of why inflation is high.
Keep the public believing, huh?
Hi, Chair Powell, Janelle Marte.
Didn't like that language.
So the Fed,
to be honest,
is facing
didn't like that language. To be honest with you,
with the revision of the financial statements from President Bostic and the President Bullard speaking at a closed
who
event.
cares?
So,
do you guys care about this? I don't.
Are saying that this is a sign of greater ethics problems at the Fed. Could you talk about what this does to the public's trust in the bank and what the Fed is doing to prevent this kind of behavior from becoming
like they already did stuff about it. Those guys aren't here anymore. So
trust is really the Fed's and any central bank's most important asset. And anytime one of the policymakers violates or falls short of those rules, we do risk undermining that trust, and we take that very seriously. We do. So at the beginning of our meeting yesterday, actually, we had a committee discussion of the full committee on the importance of holding ourselves individually and collectively accountable for knowing and following the high standard that's set out in our existing rules with respect to both personal investment activities and external communications.
Looks like it's resolving to the upside here again.
I would just say we do understand how important those issues are. I would say that our new investment program.
I'd like to see them at least wipe out that sweep that they had to 25.
The problems with President Bostic's disclosures were discovered when he filed his new disclosures. That's, we now have a central group here at the Board of Governors that looks into disclosures and follows them and approves people's disclosures and also all of their trades. Any trade anyone has to make who's covered has to be pre-approved. And there's a lag. It has to be pre-approved 45 days before it happens, so there's no ability to game market. So it's a really good system. It worked here. And I think we all said to each other yesterday morning, we recommitted to each other and to this institution to hold ourselves to the highest standards and avoid these problems.
Do you have an update on the investigations that are pending?
I don't.
Futures implied traders see 57% chance of 50 basis point hike in December.
The matter concerning President Bostic to the Inspector General. And once that happens, I don't discuss it with the Inspector General with anybody. It's just the Inspector General has the ability to do investigations. We don't really have that, so that's what he's doing.
There you go.
Michael McKee from Bloomberg Television and Radio. Earlier this year, you touted the 3-month bill yield out to 18 months as the yield curve with 100% explanatory power. And you said, quote, if it's inverted, that means the Fed's going to cut, which means the economy is weak. That curve is only 2 basis points away from inversion now. So I'm wondering why you are so confident that you have not over-tightened, particularly given that rates work with a lag.
Well, so we do monitor the near-term.
McKee to the rescue.
Right. And that's been our preferred measure. We think it, just empirically, it dominates the ones that people tend to look at, which is 2s, 10s, and things like that. So it's not inverted. And also, you have to look at why things, why the rate curve is doing what it's doing. It can be doing that because it expects cuts or because it expects inflation to come down. In this case, if you're in a situation where the markets are pricing in significant declines in inflation, that's going to affect the forward curve. So yes, we monitor it. You're right, and that's what I would say.
If I could follow up, you also said several meetings ago that the risk of doing too little outweighed the risk of doing too much. Is what you're trying to tell us today is that risk assessment has changed a little bit?
Well, what's happened is time has.
Powell did not like the way he phrased that.
75 basis points. I would not change a word in that statement, though. I think until we get inflation down, you'll be hearing that from me. Again, if we over tighten, And we don't want to. We want to get this exactly right. But if we over-tighten,
Oh man, who made that noise?
with our tools, which are powerful, as we showed
It's got to be so embarrassing.
of the pandemic episode, we can support economic activity strongly if that happens, if that's necessary. On the other hand, if you make the mistake in the other direction and you let this drag on, then it's a year or two down the road, and you're realizing.
Does she go for early presidential elections right now? What are you talking about, dude?
Actually get it. You have to go back in. By then, the risk really is that it has become.
You saying that next Tuesday is too soon? We need to wait longer?
The record is that the employment costs, the cost to the people that we don't want to hurt, they go up with the passage of time. That's really how I look at it. So that isn't going to change. What has changed, though, you're right, is we're farther along now, and I think as we're farther along, we're now focused on that. What's the level we need to get to rates, and I don't know what we'll do when we get there. By the way, it doesn't. We'll have to see. There's been no decision or discussion around exactly what steps we would take at that point. But the first thing is to find your way there.
Thank you. Chris Rugaber at Associated Press. Just to go back to housing for a minute, you mentioned the impact that rate increases have had on housing. Home sales are down 25% in the past year and so forth, but none of this is really showing up, as you know, in the government's inflation measures. And as we go forward, private real-time data is clearly showing these hits to housing. Are you going to need to put a greater weight on that in order to ascertain things like whether there's over-tightening going on? Or will you still focus as much on the more lagging government indicators?
So this is an interesting subject. So I start by saying, I guess, that the measure that's in the CPI and the PCE, it captures rents for all tenants, not just new leases. And that makes sense, actually, because for that reason, that conceptually, that's sort of the right
conceptually, it's right.
Target for monitoring.
But it's just lagged. That's all.
And the same thing is true for owner's equivalent rent, which comes off of it's a reweighting of tenant rents. The private measures are of course good at picking up the at the margin the new leases, and they tell you a couple things. One thing is I think right now, if you look at the pattern of that series of the new leases, it's very pro-cyclical. So rents went up much more than the CPI and PCE rents did, and now they're coming down faster. So the implication is that there are still, as non-new leases roll over and become and expire, right? There's still in the pipeline, there's still some significant rate increases coming, okay? But at some point, once you get through that, the new leases are going to tell you that what they're telling you is there will come a point at which rent inflation will start to come down. But that point is well out from where we are now. So we're well aware of that, of course, and we look at it. And but I would say that in terms of what the right way to think about inflation really is to look at the measure that we do look at, but considering that we also know that at some point you'll see rents coming down.
Great. And just a quick follow.
That means that, like, if we're looking for what the terminal rate is, we wouldn't be looking at
something you wanted to see. Is that a problem?
The Zoe to see where the terminal rate's going to be.
How that might affect your future policy to see this positive reaction?
We're not targeting any one or two particular things. Our message should be, what I'm trying to do is make sure that our message is clear, which is that we think we have a ways to go. We have some ground to cover with interest rates before we get to that level of interest rates that we think is sufficiently restrictive. And putting that in the statement and identifying that as a goal is an important step. And that's meant to put that question really as the important one now going forward. I've also said that we think that the level of rates that we estimated in September, the incoming data suggests that that's actually going to be higher, and that's been the pattern. I mean, I would have little confidence that the forecast, if we made a forecast today, if we were doing an SEP today, the pattern has been that one after another they go up, and that'll end when it ends. But there's no sense that inflation is coming down. It just, if you look at the I have a table of the last 12 months of 12-month readings, and there's really no pattern there. We're exactly where we were a year ago. So, okay. So I would also say it's premature to discuss pausing, and it's not something that we're thinking about. That's really not a conversation to be had now. We have a ways to go. And the last thing I'll say is that I would want people to understand our commitment to getting this done, and to not making the mistake of not doing enough, or the mistake of withdrawing our strong policy and doing that too soon. So those I control those messages, and that's my job.
Edward Lawrence with Fox Business. Thank you, Fed Chairman. So how big of a headwind is all the fiscal spending to what the Federal Reserve is trying to do to get inflation back to the 2% target?
You know, in theory, it was a headwind this year, but I do think the broader context is that you have households that have these significant amounts of savings and can keep spending. So I think those two things do tend to sort of counterbalance each other out. It appears consumer spending is still positive. It's at pretty modest growth levels. It's not shrinking, but people are, and the banks that deal with retail customers and many retailers will tell you that the consumers are still buying, and they're still they're fine. So I don't know how big the fiscal headwinds are, and they haven't shown up in the way that we thought they would in restraining spending. So it must have to do with the savings that people have.
What about the spending? There's tens of billions yet to be spent.
Outflow there, 20.
Reduction Act, the American Rescue Plan, CHIPS Act, bipartisan infrastructure bill. How does that play into your thinking about the future?
It's demand is going to have some support from those savings, and also from the strong demand that's still in the labor market. We still see pretty significant demand and a tightening labor market in some respects, although I think overall I would say it's not really tightening or loosening. So we see those things, and what those things tell us is that our job is going to require some resolve and some patience over time. We're going to have to stick with this. That's just we take all that as a given, but we know what our objective is, and we know what our tools can do, and that's how we think about it.
Last question already.
Nancy Marshall Genzer from Marketplace. I'm wondering, has the window for a soft landing narrowed? Do you still think it's possible?
Has it narrowed? Yes. Is it still possible? Yes. I think we've always said it was going to be difficult, but I think to the extent rates have to go higher and stay higher for longer, it becomes harder to see the path. It's narrowed. I would say the path has narrowed over the course of the last year, really. Hard to say. Again,
only you could quantify such things.
The sort
How
of
much?
array of data in the labor market is highly unusual, and to many economists, there is a path to. Ordinarily, there's a relationship to GDP going down and vacancies declining, translating into unemployment, or there's Okun's law. So all those things are relationships that are in the data, and they're very real. Data's a little bit different this time, though, because you have this tremendously high level of vacancies, and we think on a very steep part of the beverage curve. All I would say is that the job losses may turn out to be less than would be indicated by those traditional measures because job openings are so elevated and because the labor market is so strong. Again, that's going to be something we discover empirically. I think no one knows whether there's going to be a recession or not, and if so, how bad that recession would be.
You can tell that to all the people on the internet. They keep telling me there's definitely going to be a recession.
Have a strong labor market that benefits all over time, and that's what we're going to do.
But just real quickly, why do you feel like the window has narrowed?
Yeah, okay.
Seen, inflation coming down. The implication of inflation not coming down, and what we would expect by now to have seen is that as the supply side problems had resolved themselves, we would have expected goods inflation to come down by now, long since by now, and it really hasn't. Although it has come down, but it's not to the extent we had hoped. At the same time, now you see services inflation, core services inflation moving up. And I just think that the inflation picture has become more and more challenging over the course of this year, without question. That means that we have to have policy be more restrictive, and that narrows the path to a soft landing, I would say. Thanks very much.
Okay. So that's it. I'm gonna come over here, turn my camera back on. Mm. It's frozen. The camera's frozen. Oh, we just take another dive after he finished speaking? Oh, man. Ugh. Yuck. Yuck. You think you want to go down? Well, I tell you what, man. I am... So what I see right now is the current market price. There's no way, like, how do you determine? Okay, so let me back up. We came in today, started the day at 4.05. I think we've been I don't even think this is even close to the highs. Actually, it's a skip away from the highs. Okay, so as high as 4.075. Okay. So is the fact that we are now at 4.075 when we started the day, or ended yesterday at 4.05, is that reflective of a change in expectations about the economy? I don't think so. I think that you had a really fast move up, liquidity strained, and then like a stop run lower, and that's why we ended lower. So there would be the tendency, if you were going off of the, efficient market hypothesis, which we know is false, to say, well, that means that the market thinks that what just happened was bad overall, right? I don't think it is. I think that it's kind of, to some extent, luck of the draw. You know what I mean? You say that the NASDAQ is leading in Q. I don't know. They all look like they're moving at the same time to me, man. They're all moving around at the same time. Although it does feel like that on this leg right here, that it is the equities that are driving the action and not the treasuries. It's like positive correlation has crept in or something. So when I look at everything that I just heard, and like, what are my own changes in expectations? Let's shift this way where we listen to this song. Does what we heard shift my expectations at all? I don't think it does. I think that the change in the statement was unexpected, for sure, and I do think it is a significant change. Like, that's about the most dovish thing that you could have said in this situation. But at the end of the day, it still doesn't change like what my own estimate for the terminal rate would be. I don't see any reason for my own estimate for the terminal rate to be different from the larger market. So let's just go with the consensus estimate, 5%, right? But he did say, well, things have been higher than since the last meeting, so maybe the terminal rate is higher than 5%. That does seem to be the thing that moved them, isn't it? It was also when he said, that was, well, I'm just gonna put it right there. That's my stop. Well, I regret trying to trade that at all, but that's just kind of how it goes when you take those kinds of risks, right? That was maybe a little bit of gambling. But those, you know, it was those two statements was two. There was two. It's not lagging the market. Come on. They 100% were reacting to his comments, right? You not watching when he said that the terminal rate may be higher than our September estimates suggested. That was really when the market shifted, right? And then the other place where they turned was when he made a nod to the jobless claims data. I think one of the things would be like, if I was up there, for instance, let's say that I was Powell and I was in that situation. When they brought up the jobless claims data, I would have been putting out a bunch of reasons to be like, well, here's why the jobless claims is not necessarily like the most significant data point that we tend to look at, and blah 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 blah, right? There's some lags in that data. Not all of those created jobs are actually all of those openings are actually jobs that people can get. Some of them are unrealistic, and yeah, you know. But he doesn't say anything like that. He just says, "Well, we did see that, and that's not very good for our forecasts, right?" So that's, you know, that's a shift, right? It does matter. 100% it matters, NASDAQ killer. Every order that has been placed, just about every order that has been placed in the last 2 hours was placed based on what some person thought about what the Federal Reserve just said. Almost every single one. Come on. Whether it was entering or exiting a position based on what they just did. I just want to put some real cautious. Well, okay, so Toby says I would say it was a more hawkish tone today. So CZN. Well, so one of the things that's interesting in ZN is that from the whole time they were selling, weren't they? The treasuries were selling the whole time. That kind of makes me feel like something else is going on there. Like maybe some foreign government was like, oh, we still want to sell. This is a great opportunity. We're getting good pop. Could be. I just took a brutal hit there, man. I really thought, to be honest with you, I thought that when the press conference was done, that they would kind of like all resolve everything and they'd be like, okay, yeah, we'll go up now. It's not. It's going down quite hard. So I was very wrong. I don't think that changes the fundamentals, but I made a bad trade there, right? I misjudged. I felt that the FOMC statement, the change in the FOMC statement, was more important than anything that he said in the press conference. And that's not the way that the orders came out. The 5-year in particular started to sell very hard after he finished the press conference. That is very interesting to me. We can't, well, I'm only trying to predict the orders. Sometimes you have something that's definitely going to predict orders, but you might not be able to always accurately predict which way they're going to come, right? You have competing forces, right? I mean, like, that's the other thing, is that up until about the point that they lost 28, I would say 28 was the point where I think things really changed. Up until that point, it was just a good battle, you know? It was like I could have seen it going either way. So, but like I said, again, the 10-year, the orders in the 10-year was sell all the way. Like, it's actually now, like, this decline after he finished speaking is quite extreme. Probably overdone, to be honest. Big man. Well, it is. I think it's worthy of an explanation, because here's what's going to happen: is people are going to come out and they're going to be like, "Oh, the Federal Reserve was so hawkish today, and they totally tanked the market. And now everything is just down. This is so terrible." And then tomorrow, they'll come back, and maybe the markets just completely retrace that move. And maybe tomorrow we see interest rates down at like 3.9, for all we know. Right? And then everybody will be like, well, why? How did that happen? Right? Well, it's just the orders, right? So you want to come in, you think that because it moved after the big FOMC meeting, that move is more indicative of what the market actually thinks about the economy. And that's nonsense. If anything, it's actually less so, because the movements that you get become exaggerated because of the low liquidity, right? So that's why I'm saying, like, none of what was said shifts my own forecasts. None of what was said shifts my own forecasts. What the volume did come out in a way that I didn't expect. Right? Bloomberg Live was saying Fed not slowing down and the market dumped. Well, so the one interesting one, oh, by the way, I don't have my financial juice turned on. Let's turn that back on. I haven't seen anything further on it, but it sounds like that the SOFRs were moving around a lot, and that there was some, should we call it, contention as to whether or not the December hike would be 50 or 75 basis points. But I guess the important takeaway for me here, from a fundamental perspective, is that we did get a pivot from the Federal Reserve, basically them acknowledging that there's a lagged effect, and that we have we're in a very uncertain place where we're not 100% sure what our impact on monetary policy is, and that there's a possibility that the Fed hikes too high. Okay, that's the one, like, takeaway that I'm certain of, right? But then if that's the only thing that really changes, then really the jobs number on Friday and the CPI number on Tuesday are what matters, right? So they put that statement in there and then kind of punted.
On close imbalance, currently at 416 million to the buy side.
There's no way Powell or anyone on the planet can. Yes, there absolutely 100% is. You are delusional if you don't think that. If Jerome Powell had come out there on that floor and said, in December, we're going to raise interest rates 2%. We're going to raise interest rates 200 basis points, the market would have sold. 100% he can. Reliably. Right? I would sell my kidneys to have such, and that's exactly why you'll never be president of the Federal Reserve, right? So the question now is, where from here? I personally, I feel that this sell-off in the S&P 500 is overdone. Shall we say overdone, not justified? Just exaggerated action, right? Overly exaggerated action. But I don't know if that means that it's actually going to come back up.
In the Black Sea.
Fortunately. Like, it was good that I got out where I did. Right? So would have been another $30 if I had stayed in. That the Fed can only do so much with inflation. Well, I'm not quite sure how that's a relevant point at the moment, just because we don't know what inflation is going to be, right? Like, that would be a thing if we already knew what the CPI report on Tuesday was going to be, and we were trying to argue that the market was going to go away opposite to that because of something that Chairman Powell said, right? But that's not the argument that's being made. Just that there is some exaggerated action, but like a lot of the things that I'm saying, like you can hear everybody talk about and digest that, right? The thing that I think you're not going to hear anywhere else is that there was a very excessive amount of selling in the 10-year treasury throughout that whole period, and especially after he finished the speech. One that I don't think I can just explain as the speculators didn't like how the press conference went. That one kind of feels like a sovereign wealth fund being involved or something. That is the kind of flow that I see when another country is dumping, like when Japan was dumping their bonds before, doing policy action in the Japanese yen, for instance, right? So I feel like that there was something else going on here outside of the press conference leading to the outcome that we got. Yeah. That's something that you can only see on the tape. And it doesn't seem to line up with anything that happened. Like, here, I pull it up. I'm talking about this and I'm looking at it and you guys can't even see it. So maybe you don't understand what I'm saying. Because you're not, I would have expected you guys to react to that. Well, psychologically, trying to trade during the FOMC can ruin you, right? Okay. So here, first of all, everybody is saying the first move is usually the wrong move. What was the first move? It went down first, guys. It went down first. Okay. It went down first. Do you still not believe me on that one? Like, people were arguing with me about that one, and I'm like, no, you guys don't know what you're talking about. I feel very defensive right now, right? I mean, I took a big hit. It sucks. I did the wrong thing there, 100%. I mean, I think that the trade that I took wasn't like a terrible premise and everything. I did get, like, let's pull this up. How much did I get? It should have been only 80. I did get 30 points in favor. I really should have just bailed at 30 points. And then it wouldn't have been so miserable for me. Okay. Data series. I have to change this from a candlestick to a line on close. Okay. So now we have to go back to when the initial move. Oops. I was just almost. Okay, there we go. And what was the bottom of that? $0.50? Wow, what's the what? So somewhere in here. Oh, you know what? We need to add an indicator onto this. Hopefully it does it without me having to like reload everything. Okay. So there was a big old monster buy up there, and then it kept going down. They buy there, 0.5. I'm surprised. So there was trade and volume all the way through that. But like, look, there was like a big sell there at the beginning. One that actually took price lower than it is at the current moment. One that actually took price lower than it is at the current moment. And then we recovered. So I think that the first major move was down. That's crazy, right? But anyways, back to this. Okay. What was the point? Oh, the point that I was trying to make is this. The volume is pretty consistently down. He stopped speaking about right here. Right? There was like a huge puke there when he was done speaking. It was unusual. And look at the change in delta. That's like super extreme. Super extreme. But it was selling the whole time. And very much not in line with like what the volume was doing and everything. Like this one right here, this one was when he talked about the job listings, and this was where he talked about rate expectations probably higher, right? And the rest of this was kind of nothingness. But when you look at these two combined here, well, the delta overall was positive, but when you look at just the delta in these two, they're each about equal about it in this too, but this was also net sell. So it's just like this moves up, it was a sell. This moves up, it wasn't like the delta and the volume not in line with each other at all. And when that happens, you don't necessarily know what's going to happen, but in the end, it looks like that the delta ran out. But that's why I say that to me, that looks like there was something else going on. That looks to me like somebody really, really, really big was selling there. That like they were planning on selling it the whole time and didn't really care that it turned out the way it did with the Fed, you know? Could be wrong. I mean, it's a conspiracy theory, but I find it, I can't explain that one I can't explain that volume. So now here's why that might be important. If the move was somebody selling outside of the FOMC, it went up and they said, oh good, that's an opportunity for me to sell more.
Just taking a look again at the early market on close balance, 416 million to the buy side still.
Sorry, Newsquack speaking. Okay, so if there really was something else going on there, I think that greatly increases the chances of us seeing further downside action tomorrow, right? That's why it's sticking out to me so hard. Yeah, so Ray Sizzle says they didn't like the higher rates than thought in September part. Yes. Like I pointed out there, I drew the 2 points where they thought. There was a big reaction to when he talked about the job openings number as well, right? Both of those were about equal in size. But like I said, again, they thought the terminal rate was 4.6. was what they were was what the median forecast was. So to say now that the forecast is 5%, right? Is that actually higher than we think, right? So traders might be trading off of that and submitting their orders because of it, but like from a fundamental perspective, like the question is, okay, what is my own estimate for what? Oh, here's what the Federal Reserve's estimate was. Here's what my estimate was, right? And then the Federal Reserve says we think that the estimate is probably changed to be higher. Does that change your estimate? No, because they're saying, yeah, we agree with the market. Actually, probably we get to 5%, right? So, what I'm trying to say with that one is that I think that their reaction on that particular point was probably overdone. Should I say not overdone? It's, it's an overreaction. However, I'm not sure if that's the case for their reaction to him mentioning every time I bring up this metric, I have a hard time saying what it is because it's not one that we talk about very commonly. The jobs postings one, when he brought that one up, I think that it was justified for them to react to that, just because, when we saw that number, we thought, oh, that's going to affect what the Fed thinks about things. And then him coming in is basically, confirming that. Yeah, we didn't like that number. It's just one metric. He said that. It was like one metric that matters, that's pretty small in the larger scheme of things. Right. But it means that non-farms for Friday becomes an even bigger deal than it probably already was set to be, right? Or shall I say that it increases the risks to the downside if the jobs report on Friday is good, is what it does. You still think 37.50? Well, I'm pretty skeptical that that's going to happen before the close today. Tomorrow, yeah, 30 points, no big deal. Another thing I should point out is that I don't know, the Treasury's kind of behaved differently during the options pit close than what they would normally do. But we're back to 40070, which is like where I puked. 075 would already be a little bit better. I'm glad that I got out of that, though. Like the amount that cleared through was way too much for me. I kind of want to get back in, but I think that the amount of opportunity that's probably left here with only 15 minutes left to the S&P 500 close is not very good, right? You can never... What are you... I think you're just saying things that sound good. I don't know if that makes any sense, NASDAQ killer.
16 million to the buy side.
It sounds nice in flowery language. That sounds like a samurai, a phrase that a samurai would come up with, right? You can never predict a move by explaining it. That doesn't make... I don't know why that doesn't make sense. Would you upgrade your trading machine to an AMD 7000 or an Intel 13th gen? Saw your older trading setup video, which is very good. Okay, so first of all, I think, oh man, you're getting me onto like a completely different subject, and I'm sitting here like, how much into that do I actually want to go? if I was going to build a PC right now, I don't think I'd buy a 7th gen or sorry, either of them. Like what I see right now is that like the 5 series AMDs were like really effing, like a 5700 was a really great processor. And the shift that you get from changing generations is not that big of a bang. So in this particular generation, I mean, sometimes it happens where a new generation comes out and it's like it totally makes sense to go to the new generation, but that doesn't look like that's the case in this situation. So if I was buying a new computer right now, I would probably be more excited about last gen's hardware being so much cheaper all of a sudden, right? Now, if I really did want the newest stuff, would I get the AMD or the Intel? So I don't know if we have enough data to say conclusively that this is the case, but it's probably the case that the Intel is better right now. Okay, so the place where it's kind of gonna matter for trading is like what you're getting with multi-threaded performance and stuff. So the AMD has kind of gotten better at single core performance, but the reality is still that the AMD's real advantage comes in the multi-core processing. And so especially if it comes down to certain back testing where things have to be done linearly and you can't spread it across multiple processors. That's why I'm saying there might be some cases where the Intel might be faster, but it's probably going to be a close match, and we would really have to benchmark the specific application that we're talking about to know, right? I do like, if the question was more like, where should I invest, right? Well, semiconductors are not a great space to be in right now. But I think that things look better for Intel right now. Like, Intel's got pummeled. I think that they look good from a value perspective, and I think that their offering was good. They fixed a lot of their problems. Come on, I am talking to you. Well, you can't say you predict a move by explaining it, because it's already happened. So you're not predicting anymore. You're just trying to make sense of what happened, right? Can you predict a move from explaining the previous move? I think it helps. Right? So, and the main point that I'm trying to get back to again is I'm always thinking, well, the market's not informationally efficient. So your typical person is going to say, oh, the S&P 500 closed down for the day. That's a really bad specter for the rest of the week, right? And what I'm saying is, no, it's not. I don't think it is. Because first of all, it's like low liquidity. So every order that gets put out there, basically the impact of it is exaggerated compared to what it normally would be, right? And there was a lot of fight there at the beginning when we were higher. You know, it could have gone either way, and the degree to which we moved down probably had a lot to do with the number of people like myself that got caught, right? And then on top of that, there seems to be something else going on that I'm not even sure is related to the Federal Reserve policy at all. It's just like a good excuse to sell, because they were always planning on selling it anyways, right? So I don't think that this move today tells us a whole lot about where the market is going to be headed at all. Certainly not before Friday.
The market on close imbalance.
I think that they're going to come back tomorrow and they're going to...
That's the market on close imbalance for the...
They're just going to take this from whatever the data is that we get on Thursday, the jobless claims and stuff, right? So I don't think that this move tells us very much about the future, in other words. It does tell us something about Seth's risk management, though, doesn't it? So I took on more risk than usual because of the circumstances, but I usually don't like to trade in that circumstance. I came out, though, the news that came, like the change in the FOMC statement, 100% justified that trade. Like 100% justified me getting into a trade. Did it justify me taking on as much risk as I did? I don't think it did. I think that what happened was I got into a position and I became very, very adamant about the position. If I had just exited basically at break even when the meeting started, I probably would have been fine. And that's probably what I should have done, right? And then when they were having a reaction in the opposite direction, does that cancel out my original trade? No, because if I'm saying, no, this is a big change and I think that ultimately it means a more dovish FOMC and could maybe affect the future flows.
In May of 2023.
Yes, but on the time frame that I trade, that trade was already over and something else is affecting the flow more. So I need to be shifting and trading the current flow. And I don't like to do that. I don't like to make the shift. I still tend to be slow on these shifts, right? Afterwards, then I'm like,
yeah. Do you get comments from RBNZ's Governor Orr speaking? Also worth noting, earnings season continues after the close today.
Reporting
their fourth quarter 2022 earnings. So their estimated adjusted earnings per share.
You just have to look at that like the inverse sine law is a really big risk in this location, right? Like every time that you get the big move and you think that it's like this winner that's just going to keep going and going and going, it's either going to be that winner that keeps going and going and going, or the inverse sine law is going to come in and screw you over, right? So the inverse sine law is a bigger risk in that situation, and I did not heed it. It made a bad decision for that reason. Still like the original trade though. I did get 30 ticks out of it at one point. So that I had gotten 30 ticks out of it, then when it came down and it was 30 ticks, that should have been enough to have been like, okay, Seth, maybe we need to rethink this one. I think that part of the reason why I'm saying a lot of things that I'm saying right now is because I see a lot of people in Discord that seem to be convinced that inflation is just going to keep spiraling out of control, and that the move is to just stay short treasuries until the end of until next summer. You know, like this is the way that some of these guys are talking, and I just don't see it that way. I think that what I'm seeing from the market right now is, and especially like the timing of different leaks and other information that we get from the Federal Reserve, right? Kind of says to me that they're okay with the current rate and that we're going to rotate around this more than anything, right? That's kind of what I think. So like that's kind of like the main conclusion that I'm coming out of all of this, right? Is like, well, there was some volatility for the day. We're marginally higher rates on the day, but not huge. I think that in the end, that was like a whole bunch of drama for nothing. That's a big reason why I'm like a little mad at myself for holding that trade as much as I did, because Friday's probably going to be a bigger deal, right? Next, is it Tuesday?
5 minutes away.
When do we get the CPI?
We're also expecting comments from RBNZ's Governor Orr at the top of the hour, as well as earnings season continuing with Qualcomm reporting Q4 2022 earnings. Their estimated adjusted earnings per share of $3.13 and their estimated adjusted revenue of $11.4 billion.
The order flow on that move, though, worth watching again. Usually I'm okay with like looking. I don't know if I really have the time to go back and spend too much time on it, but it's not that often that you see a fight like that, right? It was like it fought around hard when it came back between Well, both of these, but especially from like the fight that we had from about the top of the hour until the end of the press conference, right? Was a real battle. You don't see action like that often. Real fight. And it was also really dollar driven too. That's another thing that I keep seeing, is that I feel like that it's not the volume in the treasuries that's really moving things. It's the volume in the dollar that's moving things, and the treasuries are just moving in correlation to it. It seems like there's a lot of that going on lately. Sorry for crashing the FOMC with ticks. It was a good question. You're looking to upgrade an i7 5820K machine? Yes. So here's the thing, Ray. Is I forget which one it is. I think it's the AMD. If you move over to the AMD, you got to get DDR5. So like, and it's like a new motherboard and everything, right? So if you want to upgrade to the newest thing, it's just a more expensive upgrade than usual, because like nothing will transfer over. It's going to be a brand new machine. Like the only thing that you're going to shift over is maybe your hard drives, right? So that kind of makes it difficult. Unless you're going to be already planning on spending a few thousand. But like if you want to make a $700 to $1,000 machine, doesn't make sense to go to the newest hardware. See, one of the things is that I really wanted when I had decided, okay, so this is another thing that happened, is I took the trade, so I was down here at 90, right? 99. So when it came up here to 40, I was like, okay, I gotta bail. It went up on me too quickly, but it looked like it was gonna come back. And they like just kind of barely kissed it, and I didn't take it. And then they were just like right back, a hop and skip up there so quickly. They were back there so quickly. That was very bothersome to me. That was very bothersome to me. Because I had decided that I was gonna puke it, and I was just trying to find a slightly better exit, and I pushed my luck too far. Yeah. Well, I need to think. The other thing is,
as well as Qualcomm's
both the jobless claims tomorrow and the jobs numbers on Friday are going to be pretty big events, right? But I'm wondering if I really should continue trading the high volatility stuff or not. Because really, if it would have been better for me to have not traded this, then wouldn't it be better for me to not trade the Friday either? Well, I guess it means that I really need to see something very clear. But not only do I need to see something very clear, because I think in this instance I did see something very clear, but the prices that I got for it were awful, right? Prices that I got for it were awful, because it kept going up and I wasn't really getting anything out of it. I guess part of that was being on the wrong side of the spread. A lot to think about. But I think I'm good for him from here. I can just kind of, I'm being mad about it a little bit and lift weights and everything, but we'll be fine tomorrow.
$39 billion, a miss on estimates.
Wow, look at that. Look at that volume down there in the 3768 area.
And 11 cents. Forward guidance, as they see their first quarter revenue at $9.2 billion to $10 billion. A miss on the prior estimate of $12.03 billion.
I don't. Okay, FOMC member Collins speaks tomorrow at 8
Adjusted EPS at
a.m.
$2.45 to $2.45. Prior estimates of $3.40.
So we had asked when does the CPI? It's on Thursday.
In at a miss. EPS a beat, but missing on EPS.
That's not my favorite. Oh, it's a bank holiday? What's the bank holiday? Veterans Day.
That's Qualcomm, ticker QCOM. Shares down almost 7% post-market following earnings report.
That's a tough call. I was wondering, are there going to be FOMC speakers? There could be some speakers tomorrow that like aren't on my schedule because they're like news conferences and stuff, and like you might wonder if the Federal Reserve, looks at the market reaction and doesn't like it. Like they come back and they're like, okay, Powell, you were too hawkish in your comments, so now we have to come out and say something dovish. That's the way it's been going lately, right? So that's why I was saying it was a tough call. But like ultimately, that's all just kind of splitting hairs until the non-farm jobs number comes in, right? That's just going to be like everything this week. So really, the way that this is positioned really was the FOMC doesn't matter. What matters is the jobs number. And that might be part of why the market reacted as strongly as it did when he brought that up again. It's just him confirming that it matters just means that the downside risk on a higher than expected non-farms number, more risk to the downside. That's what that means. They are trading, well, okay. There's 37.68 was the close, wasn't it? Closing longs from October. I tell you what, they sure came awfully close to that 37.50 that Pritam was saying. We sure came close to it, right? But it was just a little bit too far. Just a little bit too far for them to reach. But that's the other thing is like really, we were at 39. So we essentially lost 140 points today on the S&P 500. We lost 140 points when it didn't really change my fundamental outlook. So I'm still of the opinion that it was an overreaction. But guess we'll find out tomorrow. Okay, I think I've vented enough. I'm gonna get going. I will see you guys tomorrow. And in the meantime, stay excellent, team.